Hi, this is Drew Tignanelli. This is our November update of the Financial Pulse. I'm here with Timothy J. How are you?
I'm well, Drew. How are you?
Why is that funny?
No, it's just I enjoy the
you
way
always
you keep
never
me
know.
guessing. Yeah, you never know who I'm going to be.
Well, Timothy J. You like that?
It's good. It's solid.
And Tom Bonvissuto, our new Director of Investment Research here at the Financial Consulate. I'm going to start with Tom.
Please.
Okay. Tom, we just bought some new investments in our clients' accounts. So why don't you tell us a little bit about Harbor International and Ridgeworth floating rate?
Sure. Well, the Harbor International Fund is our move into the Europe markets to increase that exposure because we think there's some opportunities there. So Harbor is managed by a team in Boston called Northern Cross, and they have exposure to the European markets, but they also can add some emerging market exposure. Right now, they've cut that back a little bit, but they'll have exposure to Brazil, India, China, the BRICS as we call them, with Russia included in there, and that's been a great opportunity for the future because as our markets have run, we think the European markets are a good place to be as well as international. We've also added in some of our portfolios the Ridgeworth floating rate loan fund, and the reason we like that is because it takes out the interest rate risk as rates rise, but it still picks up some additional yield, doing better than a money market. Now there is some credit risk, but we think right now in the economic cycle we're in a good place. We're not concerned, and there's a good team of analysts that are looking at the names in that fund.
Tom, talk a little bit more about the credit risk, that element of it. Are we taking more risk with a floating rate fund than with a money market fund?
Definitely. We definitely are.
But you take a lot of risk with a money market fund getting zero.
It's a good point.
Yeah, that's a different kind of risk. That's an inflation risk, and it's a real return risk. So we're going to get a higher yield, but in 2008, those kinds of funds were down 20%, maybe even a little bit more, because there were defaults going on in the market. So there is greater credit risk. That's why we didn't put it in all of our portfolios, especially the ones that are more preservation focused.
Sure. We're going to have to keep our eyes on that. So that's our objective, is try to get a little better rate of return without taking interest rate risk, where that's the greatest risk right now is interest rate risk.
Yeah.
You wrote a great post about not investing in Twitter. Don't let your social media interests mix up with your portfolio. So the stock went up 73%, and people are like, I missed that, and so forth. But Tom's made a great point in some of the seminars we did recently. He says, if you put your money in your 401k plan and they match 50, 60, 70%, you make that rate of return without any risk compared to Twitter.
Yeah, and in addition to that, Drew, that's the pop that oftentimes an IPO gets. That's what people hope to get out of, but that's not an investment. It's a gamble.
Yeah. And
the people who made that gamble with Facebook, who had an equally interesting story, maybe even more interesting than Twitter, they lost a significant amount of money in that gamble. So for investors, we all still know that it's anybody's guess as to whether or not Twitter is going to be a great long-term investment, if they're going to be able to convert their loyal followers into a money printing machine, but we'll see.
Yeah, well, we had an interest in for Twitter. In other words, we were trying to get some of that new issue, but the deal was only going to come out at $15 to $20 a share. They pushed that price up by 35%.
That's amazing.
And we threw the towel in. We said, we're not paying that much more for this company. And even though it made a pop, I can't sell that stock for 30 days after it comes public. So I can't even take advantage of that if the stock starts to deteriorate, which is what I'm going to expect it. If it pulls back, that's when we'll consider buying it. It has possibility, but it's certainly not a sure bet in any way, shape, or form.
Good point.
We even know somebody who uses it.
Yeah, well, we know somebody uses it a lot. I have no idea what a tweet or a Twitter is, but he keeps telling me, you'd enjoy this. I'm like,
well, I'm going to send out a post actually today, Drew, that's designed for you to teach you how to learn about Twitter and how to
I'll make sure I pick up my twit on that.
Tweet. So, Drew, the end of the year is also coming up. Let's talk a little bit about tax planning versus merely doing one's taxes.
Yeah, well, most people want to do their tax plan when they come to see me in April. And I keep saying to them, you had to have done these things in November, December. That's the time to do it. So first you want to maximize your 401k.
Okay.
And if you haven't, you still have time to do it. You can put your whole paycheck in if you want to. And most people say, oh, I can't afford to do that. You know, you can take money out of your savings to live on for a month or so if you need to, if you have that
long as you
much
have adequate
liquidity,
savings,
if
sure.
you have that adequate savings. So that's the number one thing you want to do.
And that's $17,500 for somebody under age 50. 50 and older, you can put an additional $5,500 in there?
Right, that's
You're in the
23,000.
5,500 club, right?
Barely.
Just barely.
I'm older than both of you guys put together, actually.
I don't think that's true.
You also want to make sure you do your charitable contributing, and we talked about that last time, but one of the things that you want to do is clean out those closets and so forth, take them to Salvation Army, take them to Goodwill, and make sure that you keep track of what you gave.
Absolutely.
There's a great program called It's Deductible that you can enter the information in and what you gave away, and they'll give you a defendable number with the IRS. So that's a great thing. And Tom, we also were talking about the other day in our client portfolios, tax loss harvesting. Well, what's that all about? Are we fishing, or are we? What are we harvesting? Are we?
Maybe fish.
Yeah, well, tax loss harvesting, is one of those cases where you want to sell something that's at a loss, maybe buy into something else that's similar, and then if you still like the security, go back into that security, 31 days later. So there's a lost sale rule there. So you have to at least be out of it for 30 days. You can't, sell it today, take the loss and buy it back tomorrow. The government doesn't let you do that. And when they really want to pay you to pay taxes.
Yes.
So they make it a little bit more difficult. But if you were to have a loss in Coke, you could sell Coke and buy Pepsi, and while they're similar, they're not exact. You may get the ability to get back in, and if you still like Coke, you can sell your Pepsi and buy the Coke back, assuming the prices haven't moved all that much, 31 days later.
Ultimately works out to a present value thing. So it's not like you're eliminating taxes totally. You're just minimizing taxes in the short term. Sooner or later, you're going to have to pay them if your securities do well.
Correct.
And hopefully you always want your securities to do well.
Sure.
But it's a great strategy that you should think about, especially if you've had a big gain. We have clients that might have sold something that had a lot of gain in it, and you want to harvest those losses to bring that down. Anyway, if you have a situation like that and want to talk more about your tax loss harvesting, give us a call at Financial Consulate, 410-823-7283, and I'm sure you all know that number.
Ben, could you put that at the bottom too, because you said it a little fast.
And I think that's it.
Great.
All right.
And this is Drew Tignanelli saying God bless.